Hello, listeners. Welcome back to Money Talk Sunday, the podcast that brings economic events from all around the world into focus. I am your host, Stevie B, and today we're going to tackle a critical issue that's hitting headlines. It is the decision of Saudi Arabia and other oil-producing countries to cut oil production by 1 million barrels per day. Now, we're going to explore why this impacts the economy, drives up the price of gas, and its effect on the stock market. Don't forget to like, share, subscribe, and cue the music. All right. To begin with, let's talk about oil. Oil is a non-renewable resource and is a crucial component of our global economy. Powers our vehicles, heats our homes, and even plays a role in producing products like plastics and synthetic materials. It's an economic lifeblood, so to speak. That means when the flow of this lifeblood flows, it has significant ripple effects. Now, Saudi Arabia, along with other oil-producing nations, have agreed to cut their oil production by 1 million barrels per day. They vowed to do this. Why does this matter? Well, economics is essentially the study of supply and demand. When supply decreases and demand stays the same or even increases, prices go up. And that is exactly what is happening with oil right now. Less oil production means less supply. But our demand has not decreased. We still need this oil to fuel our cars, heat our homes, manufacture our goods. So you might be wondering, why would these companies, well, know that we need these items still, decide to cut production? Well, the big fat cats at OPEC answer lies in the status as the dominant players in the global oil market. By limiting the supply, they have the power to manipulate the prices and increase their revenue. While this may seem like a smart move for these countries, it can cause undue hardship for nations dependent on oil imports and everyday people at the gas pump. Now, when oil prices rise, the cost of producing goods and services that rely on oil also increases. Think about the transport sector. Trucks, trains, ships, they all use oil-based fuels. So when the price of oil goes up, the cost to transport goods increases. The cost to transport people increases. Companies often pass these costs on to the consumer, leading to a rise in the cost of goods. So as these costs get passed down, of course, each stop of that pass down, they're skimming off the top. Now, but the impact is not only at the consumer level. It's also felt in the broader economy. High oil prices can lead to inflation, reducing the purchasing power of consumers, which can then slow economic growth. Now, at the same time, it can create economic uncertainty, leading to decreased investment in sectors heavily dependent on oil. Zooming in on the impact on gas prices, the price you pay at the pump is directly correlated to the price of oil. When oil prices rise, gas companies must pay more to refine crude oil into gasoline. These increased costs inevitably get passed down to you and I, the consumers, leading to higher prices at the pump. So the decision of Saudi Arabia and other OPEC oil producers to cut production will almost certainly be felt in our wallets next time we go to fill up our tank. This situation underscores the importance of diversifying energy resources. If we as a global society were less dependent on oil, production cuts like this would have less impact on our economies and our daily lives. Investing in renewable energy sources not only addresses the immediate issue of volatile oil prices, but also contributes to a more sustainable and environmentally friendly future. But this is not about going green. It's talking about the OPEC cutting production and its effect on the American economy as a whole from top to bottom. So let's turn our attention to the world of investing, where oil stocks represent shares in oil companies. Now, the fortunes of these stocks are deeply tied to the price of the oil, the company's profitability, and the overall health of the energy sector. When oil production diminishes and oil prices go up, oil companies generally record higher profits, providing a positive push to their stock prices. Go figure. However, the scenario is not without its own complexities. We are living in a time of transition where the world is steadily moving away from fossil fuels in pursuit of a greener future. This shift in global policy and public sentiment might mean that a reduction in oil production doesn't necessarily lead to a sustained rise in oil prices. Why? Simply put, demand may not rise with the falling supply if consumers are already seeking out alternatives, like renewable energy resources. Investors are always peering into the future, and what they see there also impacts stock prices. When oil production is reduced, it signals that oil companies are potentially facing a future with lower demand and slimmer profits, irrespective of the temporary spike in the prices. Hence, while the immediate aftermath of reduced oil production might lead to a bump in oil stock prices, the long-term effect could be less optimistic, leading to a decline in these stocks. Furthermore, oil companies are also grappling with increased regulation, higher operating costs, and the threat of renewable energy replacing oil as a primary energy source. So, reduced oil production can be a double-edged sword. While it might increase prices and profits in the short term, it could indicate a worrisome future for the oil industry and thus dampen investor confidence in oil stocks. That's it for today's episode. Hopefully you got a better grasp on why oil production cuts by Saudi Arabia and other OPEC nations can have such a significant impact on the global economy as well as your wallet. In summary, understanding the relationship between oil production and oil stocks requires a nuanced look at several factors beyond simple supply-demand dynamics. It's not a straightforward equation, especially in today's world marked by the strong currents of sustainability and climate consciousness. So, whether you're an investor or an observer, keep your eyes wide open to these complexities to better comprehend this intricate financial landscape. Remember, knowledge is power, and understanding the forces that move our world can empower us all. Until next time, this has been Stevie B with Money Talk Sundays. Keep investing wisely. Happy trading.